inflation.
In May, inflation hit 8.6%, the highest
Inflation
in
in the
30
United
years.
States has hit 4-decade high.
Are you concerned about the rising costs of living? Do you feel like your money isn't going as far as it used to? Or are you seeking to grow your money while achieving financial freedom? Here is an easy solution I found for myself: investing. I put together a beginner's guide on how to start investing. I read dozens of books on finance and money and have been investing for over 4 years. In this video, you will learn about why investing matters, setting goals, different investment options, risk tolerance, 5 steps to open an investment account, what to do afterwards, and at the end of this video, I'll tell you about something crucial. Even Albert Einstein talked about it. Let's get into this. Why does investing matter? How does it work and how can it help you? As we all heard in the news and noticed ourselves, after the pandemic, prices and the cost of living is getting higher and higher like crazy. But it's not the first time this happened. If we look at the US dollar purchasing power, it has been falling tremendously over the last 100 years. If we look at the pictures on the bottom, it shows us what $1 used to get us back in the days. In 1913, $1 used to get us 30 Hershey bars. Today, that would cost $26. Or in 1971, we could get 17 oranges for $1. 17 oranges for $1. Or in 1971, we could get 17 oranges for $1. Today, that would cost $6.
Kobe!
If we put it in different perspective, overall, the price increase was 829%. An item that cost $100 in 1960 costs today $929. Let's look at the annual return of the US stock market, or the S&P 500. For the people who don't know the S&P 500, here is another video in which I explain more about it. As we can see on the chart of the S&P 500, that it has been growing constantly with all the ups and downs from 1949 on. Yes, there was a lost century from 1974 till 1992. But if we constantly invest every month, it will not affect our return, because if we invest in 79, it was still growing from there. And if we look at the big picture, we can see that the S&P 500 has been growing 10% in average over the last 70 years. That means while inflation is at 3.8%, we'll have a plus of 6%. Not only is investing a hedge against inflation, it's also helping you growing your money. But wait till the end when I talk about one more aspect which will help you growing your wealth massively. You need to set a specific goal for your investment, but have a realistic expectation. You won't wake up a millionaire by tomorrow. Are you looking to invest for 10, 20 or 30 years? What money goal are you trying to achieve? What are you looking for? Your first million? Or trying to retire your parents? When you have your goal set, write it down so it will stick. With your goal set, you can develop a strategy which is going to help you reaching it. Just remember to stick to one strategy, because if you're unsure and you're jumping from one idea to the next one, you'll probably make lots of errors. A strategy involves which investment vehicle you're going to buy, how much, how often, and so on. What investment vehicles are there available? Are you looking into investing in stocks, crypto, mutual funds, or ETFs?
David, wait a minute. What are all of those?
Ah yes, let me explain. Stocks. You can buy a share of a single company, like Apple, as an example. This share means that you own now a small percentage of this big company Apple. And if Apple is having a good run, people are willing to buy more shares because the company shows it's making profits and the company is more worth. That means also that every single Apple stock will be more worth. On the flip side, if Apple is selling less iPhones than expected, your shares will be worth less. The market will always determine what your shares are worth. The pros are you can have a huge upside. If you bought Tesla in 2010 for $1,000, it would have been worth around $260,000 today. They also have a high liquidity. That means you can sell stocks immediately, not like real estate, but just during the opening hours of the stock market. Yes, Wall Street needs to sleep as well. The cons are that you can pick winners but also losers. And the winners from yesterday are not the winners from today. In 2000, the 5 biggest companies were Microsoft, General Electric, Cisco, Walmart and Intel. Today, there's just one of them still in the top 5. Do you know which one it could be? Today's biggest companies are Apple, Microsoft, Google, Amazon and Tesla. So be aware of these risks because you can lose lots of money and the huge choice of options can be overwhelming. Let me tell you about crypto next. Everyone heard about it and most of us got a DM from CryptoBro420 talking about the next big crypto going on, which is going to the moon. But what is crypto actually? Hence, I'm not an expert on crypto. I asked my friend to explain it. Patrick, what is crypto?
Cryptocurrency can broadly be defined by a single term: digital ownership. As the world moves further into a digital age and becomes more reliant on the internet, we need collectively a way to establish a level of ownership. That is where blockchain technology and digital currencies come into play. The most broadly and well-known of these cryptocurrencies is Bitcoin, created in 2008 as a result of the global financial crisis, showing a weakening monetary system. The hope was Bitcoin would provide a solution. Bitcoin has currently evolved into more of a digital gold, and that is because, similarly to gold, it is scarce, it is divisible, and it is a store of value. 14 years later, there are now 23,000 different cryptocurrencies. That is in part thanks to Ethereum, the second largest cryptocurrency following Bitcoin. See, Ethereum has something called smart contracts, which is programmable money. Think about the iOS App Store, where Apple allows companies to create applications. Ethereum does something very similar, only in a decentralized manner. Many people have made a lot of money investing in cryptocurrencies. Perhaps you know someone. But because this emerging asset class is still in its infancy and void of regulations in many different parts of the world, you need to deploy a higher level of scrutiny when trying to invest in cryptocurrencies. Because of the lack of regulation, a lot of people are drawn to this emerging technology as a means to scam and take advantage of people. Remember, if it looks too good to be true, it probably is. Thank you, David. On to mutual funds.
Thank you so much for the explanation, Patrick. If you want to learn more about crypto, follow him on TikTok or YouTube. He's doing some great lives. Mutual funds are like a big basket put together by big fund managers from BlackRock, Vanguard, and so on, who are buying and selling stocks for you, so that you don't have to worry about all the losers and winners and the huge choice of options. Smart move, right? Because if you're having problems with your car, you come to my workshop and I let it get it fixed by one of my professionals. But let me tell you of one of my favorite investment vehicles: exchange traded funds.
What? Bro, what are you talking about, man?
Or just short ETFs. Those are similar to mutual funds, like a big basket of stocks. But the difference is that many of those are passively managed. Means that no one is buying or selling the stocks in the fund. So the annual management fees of those can be 33 times lower than from the actively managed mutual funds. And here's a little secret. Most actively managed funds don't outperform the S&P 500 over the long term. And here's the proof. Warren Buffett once had $1 million bet with a hedge fund manager in 2008. The mutual funds had to beat the S&P 500 over 10 years. Guess who won the bet? I give you a hint, not the manager, as he wrote on December 31st in 2017, "For all intents and purposes, the game is over, I lost." Warren Buffett won the bet and donated the $1 million to charity. What a legend. Here are the pros of ETFs. Big basket of stocks, which means you have a big diversification. Diversification means not putting all your eggs into one basket. Instead, you spread it to minimize risk. Remember, it's tough picking losers and winners, right? Very low annual fees compared to mutual funds. Passive investing, as you can set it up to be automated. And very good long-term track record. The cons are lack of control, as you can never cut out specific losers and have to buy what comes in the basket. There's also the risk of market volatility. Don't expect stocks and markets going just up. They can go up and down, and it's all part of the game. And if you need money in the near future, don't invest it, as investing is risky in the short term, a casino in the middle run, and a wealth builder in the long term. When choosing investments, it's important to consider your goals, risk tolerance, and investment timeline, and to do your research and seek professional advice if needed. Before investing, it's important to think about how much risk you can handle. This means how well you can deal with changes in the value of your investments and how comfortable you feel taking on risk to try to get more money back. Your risk tolerance will depend on several factors such as your age, income, financial goals, and personal circumstances. Generally, younger investors with a longer investment timeline may be more comfortable with taking on higher level of risk, while older investors may want to take on less risk to preserve their money. There are tools and resources available to help you figure out your risk tolerance, such as online questionnaires and working with a financial advisor. If you choose investment that match your goals and how much risk you can handle, you can reduce the chance of losing money and reach your financial goals in the future. It's important to remember that all investments come with some level of risk. For example, investing in crypto can be very risky, but a huge potential return. Stocks and funds are, compared to crypto, less risky, while bonds and saving accounts may have a lower risk but lower potential returns. It's up to you to decide which investment options are right for your risk tolerance and financial goals. So start small and diversify to minimize the risk of losing money. Before I show you how to open an investment account and actually getting started, don't forget to subscribe and tell your friends of this channel. The bigger this channel gets, the more videos I can shoot for you and teach you even more things. Let's talk about how to getting started in 5 steps. First, you'll need to select a broker like Vanguard, Goldman Sachs, Schwab, or Robinhood. Consider factors such as the broker's fees, investment options, and customer service when making your choice. It is very important to do your own research. Just type in on Google best investment broker and then compare them to each other. Next, you'll need to provide some personal and financial information such as your name, address, social security number, and employment status. The broker may also ask for information about your investment experience and goals. It is okay to be honest if you're still a beginner. Depending on your investment goals, you'll need to choose the type of account you want to open. Some common account types include individual retirement accounts, IRAs, brokerage accounts, and 401ks, or TFSA or RRSP for my northern friends in Canada. Now, you need to put some money into your account. Once your account is open, you'll need to transfer money from your bank account into an investment account. So, let's say you want to buy 1 Apple share. You search for Apple, click on the amount of how many shares you want, and then you simply click buy. In the next few seconds, you will be the proud owner of Apple. Additionally, it is important to regularly monitor your investment account to ensure that it's performing as expected and making progress towards your goals. Remember that investing is a long-term game and not a get-rich-quick scheme. Monitor your investments regularly, but be prepared for all the ups and downs. It can be a real roller coaster out there. Let's talk about the last point, which even Albert Einstein talked about it, the compound effect. To cite him, compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. But what does the compound effect do for you? If your chosen investment has a positive return, this return will become part of your initial investment for the next year and the year after, and so on. Here's an example graph to give you a better understanding. The longer the compound effect can work in your favor, the more powerful it will get. But this can also work against you if you have any personal debt. And this is the reason why Warren Buffett became one of the most richest person. Start as soon as possible, stay invested in for the long run, and wealth will just be a matter of time. Even with a small amount of money. Now we covered all the basics for you getting started. No more excuses. If you have any excuse, let me know in the comments or send me a DM on Instagram. We talked about how investing can help you grow your money, how setting goals before investing is important for your strategy, the different investment options such as stocks, crypto, mutual funds, and ETFs, how to manage your risk tolerance and how to minimize it, 5 steps to open an investment account, and that the longer you are invested, the stronger the compound effect will work for you. Thank you for your time. Do you have any tips for beginners just starting out with investing? Then please leave them in the comments. And if you are looking for a video to get started and wish to retire early, I have here a perfect video for you. See you next time, investor. Bye.